Good morning, ladies and gentlemen. It's with great honor that the Federal University of Minas Gerais School of Law receives today as a lecturer Mr. Robert Stack. Mr. Robert Stack is the Managing Director of International Taxation at Deloitte Tax LLP. He graduated from Georgetown University Law Center, where he was editor-in-chief of the Georgetown Law Journal. He also clerked for Justice Potter Stewart of the United States Supreme Court. He worked as the Deputy Assistant Secretary for International Tax Affairs in the Obama administration, where he worked directly negotiating BEPS policies with many countries in the world. Mr. Stack has a very unique experience in the field of international taxation, both in the public and the private sector. So, without further ado, I would like to thank Mr. Stack for his time and for his acceptance of our invitation. Mr. Stack, please feel free to speak. Thank you one more time.
Thank you, and it's such a delight to be here in front of a Brazilian audience. When I was the Deputy Assistant Treasury Secretary during the Obama administration, I was able to travel to Brazil with the Undersecretary for International Affairs at the Department of Treasury, where it was my first time visiting both Sao Paulo and Brasilia to meet with the Finance Ministry, talking about a range of economic issues, including tax issues back in the day. I should say that when the BEPS project, as I'll talk about, got moving along, it was not just an OECD project. As we know, Brazil is examining its own entry into the OECD, but it was an OECD G20 project. And Brazil is, of course, a member of the G20 and actually did play an important role in the BEPS project. And I'll be able to talk a little bit more about that today. So it's an honor for me to be here as well. When I talk to audiences about this type of topic and issues, what I like to do is really do two things. One is to back up institutionally and talk about the OECD, because I think it's not an organization that's known by the man and woman in the street. What is it, and why does it have all this influence in international tax? And then second, I like to talk about kind of the evolution. What got us to the BEPS project that began when I arrived at the U.S. Treasury Department in 2013. So I'll take those two little paths. The Organization for Economic Cooperation and Development began, the predecessor entity was put in place in order to implement the Marshall Plan in Europe after World War II. And that, of course, explains the fact that from the beginning, it had very heavy European membership in the organization. And then in the early 60s, its membership started to expand among developed countries, obviously mostly Western developed countries, to work on all manner of economic issues. You can think of it as a big think tank, if you will, of issues that cross the spectrum from tax issues to labor issues to environmental issues to health issues, and quite a large and prodigious organization in these areas. In the field of tax, the role of the OECD is really an outgrowth of the role that was begun to be played by the the League of Nations back in the 1920s. And what the League of Nations did, it started to work on these model tax treaties. And that work was kind of picked up by the OECD in the early 60s so that countries could have a model from which they could negotiate tax treaty provisions. And as you know, I understand you're all good, many of you, at least in the class, are good students of tax. These tax treaties, form the foundation of cross-border. And one thing to keep in mind is when you have, countries of similar development levels across the table from each other, they have similar stakes in making these provisions work kind of in both directions. In other words, the treaty doesn't necessarily favor one or the other. It's just setting the rules of the road for countries at similar levels of economic development. Now, that led to the OECD publishing model treaties. And a model just means it's used as a basis for negotiation when two countries get together. And then, as an offshoot of that, as you may know, Article 9 is the article of the treaties that embeds what's called the arm's length principle. Because when you're going to have cross-border trade, you need to have some rules so that if something is sold from one jurisdiction into another, both jurisdictions can agree on the price of that item that has been sold and purchased so that there's not double taxation, so that each entity respects the pricing at which these transactions occur. And that led to the second big area that the OECD works in, which is called transfer pricing. And the OECD writes guidelines on transfer pricing, which are to inform essentially Article 9 of the treaties. And the reason that's so important is until BEPS, the Base Erosion and Profit Shifting Project, began in 2013, that really was what the OECD did, and it does it through its Committee on Fiscal Affairs. And in the Committee on Fiscal Affairs, there are the 30 now, I think it's 37 members of the OECD sit together and consider, those important documents. The director of the Center for Administration, Tax Policy and Administration at the OECD is Pascal Saint-Amand, another very important figure in all that was BEPS and in the ongoing continuing work today. Now, while I'm on the institution, let me explain some of the expansion of that institution as it relates to the topic I'm speaking of today. As I mentioned, the OECD is only 37 countries, but the BEPS project was in effect a joint project of the OECD and G20. And I'll come back to why the G20 was so interested in this concept of BEPS. But when the G20 became interested, that meant that the project around BEPS had to expand to include not only the OECD members I mentioned, but the G20 members, including Brazil, India, China, South Africa, for example. And so for the first time around the table are a much enlarged group of countries. But even then, it was only about, let's say, 40 to 45 countries from memory, because obviously there's overlap between G20 and OECD membership. Well, after the Addis Ababa conference in Africa in 2015, it was decided that developing countries need even more representation than they have. And there's a bit of a political back and forth, if you will, between the OECD and the UN as to kind of who can really do best by developing countries. And the OECD created, after Addis Ababa, a concept of the inclusive framework. And so today we have 139 countries. We've expanded out even further, and there's 139 countries sitting around the table thinking about the work that actually you're reading about in the newspaper every day about Pillars 1 and Pillars 2. So that was the institutional journey. If I go back to BEPS, it was, again, OECD G20. So it's not as big a group as today. I should add that as a governance matter, the OECD Committee on Fiscal Affairs, that's the group, that's the room where everybody sits around the table with their country's names in front of them and a flag of representing their country. There's a group that directs that group called the Steering Committee. And the Steering Committee is very, very important because they're really doing the setting of the agenda for that larger group. And I want to add that back when we were doing BEPS, Brazil and South Africa and China and India were brought onto the Steering Committee and therefore played, very, very important roles throughout all of BEPS. I was just remembering Zaida Maneta was the representative of Brazil to the steering committee when I was at Treasury. She's now I think the executive director of the Global Forum on exchange of information at the OECD. But lots and lots of spirited exchanges on lots of issues that I'll try to talk about as well. So Brazil was a serious player in many respects, going back into BEPS 1. So that's the institutional lay of the land. What about the substantive lay of the land? Kind of how did we get to this spot? Well, for this, I have to back up a little bit to the 1990s, believe it or not. In the 1990s, there began a project at the OECD about harmful tax practices. And the idea in the 1990s was that tax havens, which frankly is not really a defined term, but think of it as places with zero tax rates. They're often made fun of as sandy beaches or places where you don't need any people to do anything. But the zero rate, and I'm going to use zero because I distinguish it from, let's say, more developed countries that have lower rates, let's say 9 or 12.5, which is much more controversial, whether, for example, those should be called tax havens for a variety of reasons. But in the 90s, the question was the instability created in the system by zero tax rate places. And they began to look at the problem from the point of view of what are the characteristics of those havens that should be called out as, let's say, not appropriate behavior in the international community so that perhaps countries could take defensive measures or the like. This is a good point to mention, of course, that one of the other substantive drivers of instability in international tax is what we call the mobility of capital and intellectual property. Well, what do I mean by that? Well, to put it very simply, if you put a bunch of really valuable intangible property in Bermuda and it attracts royalties from all over the world, let's say you've designed some wonderful process of an engine that can send people to Mars, and you put that in Bermuda, and it can collect royalties from all over the world, what you've done is you've reduced your taxes in the places that are paying the royalty, and you're paying no tax in Bermuda because it doesn't have an income tax. Well, and you might, instead of intellectual property, you might put just $1 billion in Bermuda and lend it all over the world, and it could collect interest and not be taxed in Bermuda. And why do I say mobile? Well, if you think about it, to own intellectual property in a jurisdiction doesn't take much. Maybe you just register it somewhere. To own a bank account in a jurisdiction doesn't take much. So companies have this flexibility to move these assets around the world. And that creates this intersection between the mobile assets and the instability created by the zero tax places. Huge problem. Well, the 1990s starts to set out and say, we really have to look at those zero tax places and have some rules about them. We have to define them. And interestingly, one of the things that was happening in the 90s to define them was they were going to say things like, well, low tax rates itself is like an indication of perhaps being a bad actor. There were other aspects too, like ring fencing of certain types of businesses, different treatment of onshore and offshore income, et cetera. But one of the drivers was rates. Well, guess what? In 2000, along comes President George W. Bush wins the US election. And they enter into the debate at the OECD, and they say, wait a second, rates are not a problem. Countries should compete against each other to attract investment through different rates. And essentially, they kind of blew up the whole harmful tax practice project of the 90s because they refused to get on board with the idea that focusing on, let's say, the local country issue around rates was going to be a productive path. In fact, they thought it was counterproductive. What's fascinating about this is that drove that work from the 90s into the path around increasing international cooperation around the exchange of tax information. What grew out of that work from the 90s was a whole stream of work that resulted ultimately in FATCA in the United States and the Common Reporting Standard around the world, a very important stream of work. And before that, all sorts of international rules and agreements around exchange of information. In other words, governments said, okay, we're not going to tell countries what rates to have, but what we can do is ensure that all governments are good players. And being a good player means if my citizen has a bank account in your jurisdiction, or I need information around one of my residents that's in your jurisdiction, you will cooperate and exchange that information with other tax authorities. And there's a variety of measures around exchange of information, tax transparency, and being good global citizens. And by the way, one of the reasons these countries object to the label tax havens is, in fact, they have all been extraordinarily cooperative with all of these international efforts around exchange of information, common reporting standard, and the like. And that stream was vitally important. Now, let's go back to the instability created by the zero tax places. Well, as I mentioned, it kind of lost the steam about defining a tax haven, let's say, inward and focusing on fixing their domestic laws, to getting to BEPS, which takes a totally different approach. BEPS was saying, well, let's not focus on the rules of the tax havens. Let's focus on our own rules as the developed countries and how they enable the tax arbitrage that can happen due to tax havens and low tax jurisdictions. You see, it's a fundamentally different mindset of where do you attack the problem. And the BEPS mindset was, wait a second, we, the countries that have the multinationals, we write the rules. We write the rules that permit the use of tax havens. And if you could sum up BEPS in a nutshell, the idea is that it is all about looking at the rules of the countries where the companies are resident and trying to ensure that they cannot utilize the gaps in the system in order to take advantage of those gaps and facilitate the shifting of profits into low tax jurisdictions, resulting in either zero tax or what we call non-taxation, or even double non-taxation, income that's taxed nowhere. Huge shift. Now, of course, the other impetus for the BEPS project was the financial crisis. And by the way, I should say that as an American, this element of BEPS did not hit U.S. politics as strongly as it did European politics. And by the way, if there's one big takeaway today that you should appreciate, is that Europe plays a very, very strong role in all these international, because A, it has so many members at the OECD. Remember, I said it has its origin as a European enterprise, essentially, and because of the more and more active role that the EU is playing. And I should add some of the European frustration about the fact that they have what they think of as internal tax havens that cause themselves problems, because the EU did not harm tax at the EU level when it was created in the 50s and 60s. And so they have their own sets of problems from a lack of harmonization of tax in Europe. So the financial crisis, of course, really hits the man and woman in the street in Europe and all over the world in very, very harsh ways, more than it did in the United States. So that businesses, so that the man and woman in the street might have been losing pensions. They might have been losing the ability to take early retirement. They might have been losing jobs because governments were cutting way back, and there were recessions in these countries. And there was a lingering flame of resentment about the question of whether multinationals, pay their fair share. And so one way to think of the start of BEPS, and again, it gets first mentioned in a communique from Cabo San Lucca in June of 2012. President Obama is at the Leaders Summit, and they start to talk about needing to tame and look at the fact of whether or not multinational corporations are paying their fair share. And that is kind of the glimmer of the very beginning of the BEPS project in 2012. But it's really the intersection, that lingering question back from the 90s. What do we do about this instability of immobile income? What do we do about the instability caused by tax havens? With the now new political impetus from the financial crisis in 2008 and 2009, that now is the time to act. You cannot, by the way, I don't think in fairness, you cannot overlook the fact that in the same period, the 2012-13 period, Pascal Saint-Amand takes over as the director of the Center for Tax Policy and Administration at the OECD. And Pascal has kind of one frustration with the old way that the OECD worked was, they could have a project that at the OECD that could go on for 10 years. And his frustration was, wow, this needs action. It needs faster action. And so one of the very, very first things that happens in the BEPS action plan is to give it a 2-year deadline. Can you imagine? When BEPS began, we came up with 15 action items, things that really needed attention. And we said we would have reports 2 years from 2013 when the action plan came out. And, much of the world said, this is crazy. It's never going to happen. But it did happen. And I will say that the part of the genius, and I have to attribute part of this genius to Pascal, is to realize that if you don't keep tight deadlines on political movements, they kind of peter out and everybody gets bored and everybody says, well, that thing is going to go on for 10 years or more. So part of the genius was to do the action plan, in that time period. So now, what was in the action plan? And I'm actually wondering, I think I can share my screen. Would that be okay?
Sure.
I see, because I have, let's see what it says here. Because I have a screen, I had a screen open. Here we go. Can you folks see that screen?
Not yet.
Not yet. Okay, I must have to do one more thing. Oh, wait. All right, give me 1 second here. I know what I'm going to do. I'm going to pull this over to my second screen. And then I'm going to come back here. And I'm going to say, oh, here we go. Great. Okay. How about now?
No, but if you'd like to maybe send me the file, maybe I could try to share.
Hold on. It says StreamYard is sharing your screen. It says I'm sharing. Do I click on this? I'll try one more time, and then if not, I can just talk it through. Sharing is easy with at least 2 monitors. Screen 2, share. Still no good?
No, Mr. Stack.
Okay, well, listen, what I'm going to do is what I had was just a picture of the action plan that came out in March of 2013. But what I'd like to do now is just take you through the elements of the action plan. And then I want to talk a little bit about why the action plan, is that up there now?
Yeah, it's open now. Good.
Super duper.
All right.
And so this is the action plan. It came out in the summer of 2013, actually, like June or July. The reason I wanted to scroll through it is I want to just show you the actual items. But before I do that, let me just, I want to step back and I want to give you the buckets. Like, what were the main concerns of BEPS? And kind of give you the broad outline of what we were trying to do in BEPS. And one bucket is a pretty interesting and simple bucket, and I'll just explain it, which is there are lots of situations. Remember I mentioned you could have a loan from Bermuda into the rest of the world, and you'd get deductions in the rest of the world, and you'd get income in Bermuda interest on the loan, and there'd be no tax. So one sort of issue that the world has long struggled with is how much interest should really be deductible among related parties. And many countries have rules around this, but it was one area where, remember, I said BEPS was going to be about this what we call arbitrage between jurisdictions. And now in BEPS, it wasn't going to be, oh, that's the fault of Bermuda for having no tax. The question in BEPS was going to be, what can the countries that give the deductions for the interest do? So let me just throw a couple more things in that bucket. Similarly, in that bucket, there's something called hybrid instruments. Hybrid instruments are instruments that are treated, let's say, as a loan in one jurisdiction, but as equity in a corporation in the other jurisdiction. So I'll give you an example. You put money into a company, and the company paying back that money treats it as deductible interest, and that reduces tax in the paying country. But the country receiving that money treats it as dividend on stock. And many countries don't tax dividends on stock because they have participation exemptions. So this kind of bucket of cases around these kind of interconnections between two sets of rules, was one bucket. Treaty issues around permanent establishments was another bucket, and that related to the fact that a big company might sell into a jurisdiction and only put a small little sales shop in the country, and the country of purchase where they're selling into, loses out on a lot of the profits of the enterprise. So there's a couple of items that are all around, permanent establishments, and when is a presence sufficient in another country, and under what circumstances, to create, taxation. There's a third bucket around transfer pricing. In fact, there's 3 of the 13 items are all about that core topic I talked about in transfer pricing. And then there's a few more on stopping harmful taxes. So and then finally, and this is the one I'm going to end with, even though it's action 1, was the taxation of the digital economy. Because the taxation of the digital economy is something that lives on today, but was really kind of a pet peeve of jurisdictions, all over the world, even back in 2012 and 13. And the main irritant was that the big tech companies could kind of sell into jurisdictions without having to have a physical presence, and therefore not have a lot of profit. And that implicated a lot of the other rules that we'll talk about. So I just thought what I would do, actually, just talk you through this, is just kind of go through the action items in the actual action plan. And I can give a brief introduction on each of them and try to tie them into my broader themes of what BEPS was trying to do. The action plan called for 15 reports in 2 years, and action 1 was this digital economy point, which I'll come back to. Address the tax challenges of the digital economy. And I was the co-chair of the Digital Economy Task Force with my French counterpart. And I used to call it putting 2 scorpions in a bottle, because the French really, really wanted to tax the US tech giants. And I, as the US representative, didn't really, really want the world to write new rules just for our companies. But I'll come back to that one. I mentioned what we call hybrid mismatch arrangements. That was my example where you can get a deduction in one country, but the other country simply views that instrument differently, or it views the entity differently. And so there was a huge report. It's over 400 pages on this. This was ultimately adopted in Europe, in ATAD, and in various countries around the world, putting in new rules about hybrid entities after the report came out in 2015. Now, here's another one that actually we're seeing life today through the proposed minimum tax around the world. Strengthening CFC rules is really about the fact that if your country, and by the way, Brazil, as I understand it, has very, very strong CFC rules. In fact, as I understand it, the income of the Brazilian subsidiaries is taxed in Brazil. So those are, in effect, the strongest CFC rules in the world. But the concept is, if I let my companies have no tax outside my country, and I have a tax rate inside my country, everybody is going to be incentivized to shift income outside my parent country into other countries. And CFC rules say, well, wait a second, certain types of income you earn offshore will flow back up onto the US return, and therefore you didn't get any benefit by shifting that activity outside the country. So this action was about strengthening CFC rules. To be honest, this was a pretty weak one, because at the time, not all countries wanted to strengthen CFC rules. The UK, for example, wants to be a headquarters country for the world. And so it was in their interest to kind of keep these rules kind of weak, because you can say, hey, come put your headquarters in London. You don't have to worry about strong CFC rules. So CFC rules is a type of competition that countries engage in to attract headquarter companies. But keep this one in mind, because when we get to the work that you're reading about in the newspapers today of a global minimum tax, it has its roots in this action item. And indeed, in this very report, the US was successful in including a minimum tax proposal that at the time was the proposal of the Obama administration. Now, it didn't get taken up then, but you see it's all over the press now. Action 4, I mentioned this one already, the bucket of limit base erosion via interest deductions and financial payments. So that was what can countries do to protect their tax base through things like limitations on interest deductibility. Very productive work, I would say, in all of these action items, and lots of global consensus around the rules that ultimately emerge from these. Action 5 was actually a really important one. I didn't put this one in a bucket, but it kind of has its own bucket, which is many countries at the time when we started BEPS, many countries had enacted something called patent boxes. And a patent box simply said, hey, put your intellectual property here, and you can use the ownership here to get a special low rate. So maybe you'll only pay 6% or 10% in the UK on the income in the patent box, but you'll get deductions worth much more in the countries paying royalties into the patent box. And what was so bad about these patent boxes was you didn't have to do anything in the country where you put your IP. And so Action 5 built the rules that said, well, wait a second, if you're going to give some kind of a benefit for intellectual property, you'd better connect it to a certain amount of research and development being done in that jurisdiction. And there was a huge tussle at the beginning of this when the UK actually had to pull down its patent box because it was in violation of these rules, although it did manage to negotiate a healthy grandfather period. The second part, and by the way, this would then evaluate all sorts of potential harmful tax practices so that countries that kind of fall into the net, patent box is just one example of a harmful tax practice, kind of would have to give them up because the global consensus would be, certain types of incentives are okay and certain types of incentives are bad. But the focus was, if you're going to give an incentive, it needs to tie to real activity in the jurisdiction. Now, the second half of this action item related to something, again, very useful for tax administrations, which was just the exchange of rulings. Like if my country gave your company a ruling on transfer pricing, that other country might be interested in seeing that ruling because it affects them too. And so there's a variety of rulings that tax authorities give that are now exchanged under this Action 5. Action 6 was very controversial, but one of the big problems in treaties is the fact that I think if you look at let's say Africa and Mauritius, and even to some degree Latin America, residents that can enter Latin American treaty systems through places like Spain, even though they may not have a big connection among the shareholders of that Spanish entity to Spain, the question is, should that Spanish entity coming into Brazil, or Portuguese entity coming into Brazil, get treaty benefits? The US has very strict rules called limitation on benefits rules. You're not going to just be able to set up an entity in Portugal under the US rules and get benefits in Brazil unless you meet certain strict requirements around who owns that Portuguese entity. Are they Portuguese? Or are they Americans? Or are they other people who don't get treaty benefits? And what do they do in Portugal? Well, the rest of the world didn't like this idea of having the US limitation of benefits rules, but rather took on an approach that said, if a principal purpose of using a treaty is to kind of get the treaty benefits without anything else, countries are going to be free to deny the treaty benefits. Now, my own complaint about this rule is it's extraordinarily subjective and nobody really knows what it means. And so I think it takes away from certainty, but there was a lot of support for that in the world. Action 7 was concerned that what we call the artificial avoidance of PE status. Action 7 was concerned that countries could take a variety of ways to avoid having a permanent establishment in a jurisdiction that needed to be fixed up. So the one example might be you could have a bunch of people running around doing just sales and marketing, but not really concluding the contract finally. And the company involved said, I don't have a permanent establishment. I just have to pay cost plus to my sales and marketing people. So Action 7 was aimed at kind of fixing these PE rules to make it easier to have countries to declare that there was a PE. Now, transfer pricing was all of 8, 9, and 10. And here I'm going to go back to my opening example around intellectual property. And remember in my introductory example, I said you could just put the intellectual property in Bermuda and you didn't have to do anything else and you could get all the royalties from it. Well, excuse me, one of the huge contributions, and this took up hours and hours and hours of time, because the problem is if you look at the arm's length standard in let's say a purist form, theoretical form, the mere ownership of that intangible in Bermuda is enough, because if you own all that process stuff I talked about, you do have the right to collect royalties from anywhere in the world. So you had to marry up, let's say, the pure approach to transfer pricing with the practical political problem that it had become unsustainable politically for the transfer pricing rules to result in outsized profits in places with zero tax. And this was the central problem of 8 through 10. And they solved it by essentially saying, if you're going to put profits in Bermuda, you better have people there who do something, that know something about the IP, that can direct and manage its exploitation around the world. And this became something known as the DEMPI functions, the development, enhancement, protection, exploitation of your IP has got to have links to the jurisdiction that's seeking to get the benefits. And I will say this has had enormous impact on transfer pricing around the world as companies are looking back at their supply chains to realize whether or not they can satisfy the requirements to put profits in lower tax jurisdictions, depending upon whether they really have the people there that can know and own and manage the risks associated with and the concepts embedded in that IP. So that's kind of 8 through 10 in a nutshell there. Action 11 was something that's kind of interesting, I think, for perhaps academics, because it's a little known one, but it was to establish methodologies to collect and analyze data on BEPS. One of the problems you run into, and by the way, I see this every day really as I read stuff that comes out really from everybody, but also the NGOs, there's a whole data war that goes on in the international tax space. Companies don't pay their fair share. Companies have low effective rates. The finance minister of France likes to say tech companies, pay a rate of X, and it's been proven to be wrong. What numbers are we going to use, and how do we get the data so we can actually do a good analysis of international tax policy? So 11, although it got no publicity, is really important because behind the scenes we've improved the collection of data. Action 12 was to require taxpayers to disclose their aggressive tax planning arrangements. This is something the US has. It led to something called DAX 6 in Europe, where there's reporting requirements that if you're going to engage in a transaction that we, the government, want to know about, we're going to give you rules to say, hey, if it has certain characteristics, you have to put that on your tax return and say, we did this transaction this year, so that the tax authorities have an ability to come back after it. Now, the danger with these sort of provisions is that you collect so much information, you overwhelm the tax authorities, and they really can't follow up because they've made their request so broad. But this was what Action 12 was aiming at. Action 13 was really what led to country-by-country reporting to tax authorities. Here, the theory was tax authorities, in order to risk assess a company, need to see a snapshot. Where are that company's profits situated around the world? So if a country sees that there's a ton of profits in a zero tax place, they may want to take a closer look to see, well, should it really be there? Particularly since the DEMPI requirements came along, because they may want to go and see whether that zero tax place has enough substance. So country by country, the big battle here was that it should be for tax authorities only, not public at the time, but it wasn't really a battle. It was decided going in. And you seeing today in Europe, they're trying to expand this, to making it public. I will say this is one area where there was a lot of back and forth between me and the Brazilian delegates on not only the content of this, and the Indian delegates played a big role in terms of what is the information that should be in here, but also on the question of, remember, the US and Brazil don't have a tax treaty. So what are the circumstances in which the US will hand over the country-by-country filings in the US to Brazil? And, are there certain agreements that are going to be needed between countries before that country could just ask for that filing locally? So this was a huge area of debate, and I even remember some late-night meetings. But this became, I think, one of the central issues that came out in BEPS. Action 14 should not be overlooked because it's a little behind the scenes, but it was companies complained that when they had international tax disputes, it took years and years to resolve them. And Action 14 was all about improving what's called the mutual agreement process, so that countries put more resources into solving international tax disputes, so companies can get the certainty they need, to function, and that would all lead to investment. And then the last one, of course, is the multilateral instrument, because a lot of this got embedded in a multilateral instrument that would amend bilateral treaties. To this day, that multilateral instrument's been signed by 95 countries, but only ratified by 65. And but a lot of what I described above with respect to permanent establishments, treaty abuse rules like the principal purpose test, are embedded in these in this multilateral instrument, which had the effect of amending bilateral treaties. Now, I promised I would go back to digital, and I'll close on the digital. All these reports came out in 2015, and countries around the world with different timing have adopted them around the world, including the US and its TCJA with new hybrid rules and interest deductibility rules, including the Europeans with the ATAD rules. And I know many other countries have enacted items that came off of these rules. Now, let me go back to the digital to close, because it actually brings us up to the current time. So I mentioned that when I was, the one thing I should have said is that the OECD acts by consensus, which means everybody in the room has to kind of agree to something before it comes out as an OECD product. Now, when you got to the OECD project, the digital project, yes, countries were concerned about three things about digital companies that they said made them different from all other companies. First, companies could get content from people in the jurisdictions. So when a person puts a picture of their cat on a social media platform, the argument is that that person in the country is contributing to the content, and therefore they are kind of creating value in that jurisdiction. Second, these companies collect a lot of data, and people say, well, that's a game changer, that's new, and that should have different rules. And third, there are what's called these network effects. You know, your social media platform is only valuable if you have X million Brazilians on it, as opposed to 25, or you have X million Brazilians and Y million people in Europe who can talk together. And so those three characteristics. The U.S. complaint was that the world was just coming at our tech companies, and that this whole project seemed aimed at one country's industry where it predominated. And the U.S. was not willing to rewrite the rules, just for tech. One of the outcomes of this project was to say that you can't ring fence the digital economy, because think about it. Think of a company today that you can't say doesn't have some digital aspect. So how successful are we going to be in that? Now, if you roll forward to today, and I'm watching the clock here, I want to leave Professor time for some questions and also keep to my time limit. What's happened today is the U.S., under three administrations, the Obama administration, the Trump administration, and now the Biden administration, has said, we will rewrite the rules about what markets get to tax, but it can't just be for big tech. It's got to include more than big tech. And that's what Pillar 1 has taken us to, which says, let's take the 100 biggest, most profitable companies and take a portion of their profits and sprinkle it, among the market jurisdictions. Pillar 2 is actually saying, well, there were remaining BEPS concerns. And that minimum tax idea that the Obama folks put in BEPS Action 3 or 4 several years ago, let's bring that back. Because what we really need to do is just ensure that companies pay a certain minimum level of tax. And that has brought this forward. I will say that it's the digital work that was unfinished in the view mostly of the Europeans that drove us to where we are today, because they were dissatisfied that Action 1 had really changed any words, had laws, and therefore they stayed at it by starting things like digital service taxes and the like. And, to fast forward to today, we're seeing the compromise that ultimately grew out of all the stalemate that had started back in Action 1 on the digital. So let me just close with just a generalization. Was the BEPS project effective? Well, you bet it was. I mean, as it's still in practice in the United States, I can go through virtually every one of these action items and see real world impacts it's had on domestic law and on practices of companies. Were there controversial elements? Yes. Transfer pricing was tough because the U.S. defended the arm's length principle, not because it's the greatest thing ever, but because without it, we feared a certain chaos or a certain incredible subjectivity in how you define and administer transfer pricing rules. So we were really trying to protect certainty over subjectivity of tax administrations. And that was the main battle in that one. And then digital, of course, was controversial and remains controversial. But stepping back from the controversy, I wanted to show you a lot of these very vanilla provisions because they have had real world impact. And I think from a tax policy perspective, were really incredibly well done. I'll just close on a word for the secretariat at the OECD. Those are the professional people that work in the offices, kind of like your ministry people or our ministry people in the US. Very highly effective, smart, hardworking people, very good at tax policy and working hard to kind of broker the interests of all the countries around the world that have stakes in this really, really important business. So with that, Professor, I did leave you hopefully a minute or two for a question, but there's a lot of material there. I hope I didn't do too much, but I'll pause there.
Mr. Stack, it was extraordinary to listen to you. You're part of international taxation, and your lecture was just amazing. That's the only word I can use to describe it. So thank you.
Very kind.
Very much indeed. So just one question I'd like to ask now, since we're online, and before we go to our closed session with the PhD students. As a representative of the Obama administration in this project and dealing with all the world actors. How did you see Brazil's performance and interests being placed within the G20 and, of course, within the BEPS project? How do you think we fit in the global community?
Yeah, sure. So first of all, I just want to open by saying Brazil sent very, very strong representatives to the OECD project in the G20. I mentioned Zaida, who I got to know. And that's really important because, it's a pretty high level group and you need your best players in the room. You need smart people, you need technically strong people. And Brazil, I think, delivered on that. And as a result, had real impact on the work. I mentioned the work on country by country, but there were other areas certainly where they and other non-OECD G20 countries had enormous impact, as did India, I think. But the one thing that I enjoyed, thanks to having the opportunity to visit Brazil, and once I visit a country, I try to follow the news very closely once I leave, is it gives you a very keen insight into the different challenges that different countries face, on a day-to-day basis across the economic and social spectrums, across a variety of issues. And it helped me as the American representative kind of understand and take into account, the viewpoints of these various countries around the table. And that was also a kind of a side benefit of all of this work. And so again, my hat's off to the Brazilian delegates. I think they did a wonderful job. They were very much taken seriously, and they were very good to work with in that process.
Well, it's very good to hear that, Mr. Stack. Thank you very much. And respecting the time, we're now ending this session, but I'd like to hear publicly, thank you, not only for coming here, but for making so much for international taxation and searching for a more fair and just distribution of the tax burden without any biases. And I think that's something that we learned from your lecture today. We can't have biases. We need to see the problem as a whole and then address the correct issues. So thank you very much, Mr. Stack.
Thank you. And now I'll join on the other link.
All right. Thank you very much.
Thank you. Thanks, everyone, for having me. Have a great day.